Welcome to Investors Insights. Our topic today, behind the headlines. I'm excited about this topic today because so many times we have clients calling saying, hey, I heard this, I read this, only to find out that as we did research on those topics, maybe that wasn't the case involving the article, the newscast, or the headline. I think you're going to thoroughly enjoy today's discussion. I'm joined by my distinguished colleagues who I thoroughly like to brainstorm with and debate, Trey Booth, Bobby Norman, and Ty Miller. Guys, it's great to see you this morning coming out of this Portfolio Strategies meeting. It was fun. It was very insightful. So thanks for all the work you do in drilling down on these topics. Bobby, you talked about operating margins. I think it's really important because we're hearing that corporate America may not be doing as well. We hear about inflation, we hear about tariffs, all these things, but your data says something different. Talk about that.
Yeah, so now that we have finished up earnings season, we are analyzing the results, and our conclusion is that the fundamental backdrop for the equity market remains quite strong. The margin profile remains one of the key gauges we monitor when assessing overall market health. And as you can see in this chart, we continue to see companies that make up the S&P 500 have operating margins coming at all-time highs, now sitting at 20.3%. This matters because operating margin measures a company's profitability from its core business operations, and it shows how many cents of operating profit are generated for every dollar of sales after covering production-related costs. So, but perhaps more importantly, you think about if artificial intelligence ultimately proves to be as beneficial as the market currently expects, we believe those benefits should increasingly be reflected in equal weight operated margins. So, and actually those margins are just shy of record levels, but the continued upward trajectory suggests that productivity gains and operational efficiencies are beginning to emerge more broadly across the market. And it's great to see that Wall Street and investors are not being distracted by the current uncertainties in the Middle East and uncertainties that the market is usually fighting this time of year, being a midterm election year, and instead are focused on record profit margins. So we'll continue to update our viewers on corporate earnings strength, but so far so good. Corporate profit margins are really impressive right now.
Yeah, so, and Bobby, I thought that was great how you presented it. Let me also say this. If companies are making money, that means consumers, someone is buying products. You agree with me on that, and services?
Absolutely. Yeah, that's the key part. Sales.
And that ties into, Trey, what you brought up. If people are spending money, do they have the ability to buy things, or are they, just turning around and putting it on the credit card? So, it's one thing to say companies are making money for, services and their products, but the consumer's the one spending that money, and where's that money coming from? So talk about that.
Yeah, thanks, Craig. Yeah, so reading newspaper this weekend, I'm going to read the headline: Americans strain to pay down $1.25 trillion of credit card bill. So that's somewhat concerning. So that calls me to take a pause and try and dig into what's driving that. And that's somewhat misleading. I know that might be surprising that the newspaper might put a little less than truthful headline at the top of the fold, but still, that still caught my eye and calls us to do some research. And so I want to look under the hood. Yes, there is higher consumer debt, but debt isn't necessarily a bad thing. Every month I take on consumer debt and I pay it off at the end of the month for the points, and we're nonetheless worse off. So what is important is not necessarily the level of credit card data; it's the delinquency data. Now, there's been a lot of data coming out about the consumer, and so let's look at the delinquency. You can see on this chart, this is a 20-plus year chart going back to the early 1990s. You can see delinquencies are actually coming down at 2.92%, down from a high of over 3 earlier in 2024, and well below highs seen back in the Great Financial Crisis. So delinquency rates, so people may be taking on more credit, but they're able to pay it off. So how are they able to pay it off? That's because initial jobless claims, you talk about headlines, there's been a lot of headlines of layoffs and technology taking jobs, but jobless claims remain stubbornly low. So if people are losing jobs, they're not telling anybody, they're not filing unemployment claims. As long as people remain employed, they're able to keep up with their financing needs. We saw in the month of April, consumer spending, personal spending went up 0.5%, and wages were flat. So that does indicate that consumers are pulling forward some future wages, or they're borrowing, or they could be spending larger tax refunds. So there's a lot of reasons for maybe personal consumption being higher. It's not sustainable in perpetuity. You can't spend more than you make forever. We're seeing the personal savings rate drop to 2.6%, but it can be sustained for a while as long as you have a growing economy where profits are strong and employment stays high. So what's very important is we're going to watch this week. The unemployment report comes out on Friday. That's extremely important. We need to keep the consumer employed because that also keeps the stock market going. A record high, 47% of households now own U.S. equities. So that is a strength of the economy, strength of equities. We need to see people continuing to save, invest, and spend to keep this going.
Yeah, and that's why we chose the topic behind the headlines. That's a great example, both what Bobby and you have shown here. We're seeing headlines and on the credit issues, delinquent, credit payments. But the reality of it is, it still looks very reasonable. And you drill down on that. And so thanks for, seeing a headline like that and other headlines very similar and, drilling down on that to get the right information. That's what this vlog is about. It's about providing to our clients information that regardless of what they're hearing on the news or in what they're reading in publications, we're trying to bring them the facts that tie to those headlines. And then Ty, you can sum it up here for us, because the other thing we continue to hear is that the market's in a bubble, but data doesn't show that. And so talk to us in relation to what Bobby and Trey have talked about. Now let's just look at the market straight on and show us what you're seeing.
Yeah, it's something we brought up a couple of times that a lot of clients, continue to say, hey, this AI bubble, I'm concerned about it. When is it going to end? Things of that nature. And so our research partner, Strategas, went back to the 1990s bull market, which was really helpful because that kind of was a true bubble, the tech bubble, of course. And so comparing then to now, which is interesting. So as you see in this chart, this is the 1990s bull market. Dividends are in yellow, earnings are in blue, and the multiple expansion is in red. And then the total return is the solid line. Now, multiple expansion, is essentially, think of a price to earnings multiple. If you would pay $10 for 2 earnings of profit, that's a multiple of 5. You're paying $5 for every kind of earning there, for every dollar of earnings. What we had in the 1990s at the beginning was earnings were actually decreasing, and so it was like going from paying $10 for a stock for $2 of earnings to paying $10 for that same stock with only $1 of earnings. So earnings were actually decreasing. It was entirely multiple expansion. Why does multiple expansion happen? Because people get excited about the future. They see the headlines and they say, hey, while maybe right now it's not producing, we think in the future this is going to be a worthwhile time. But then as you see, in the mid 90s, earnings did start to catch up, but never really became that strong outperformer. And then at the end of the 90s in the tech bubble, multiple expansion really took over again. So again, these stocks aren't any more valuable necessarily. They're priced based on earnings, but their price continued to go up. That's kind of what a bull market looks like, where you're not seeing the results, but prices continue to elevate. If you compare that today to the current bull market, which we've been in since the second half of 2023, you can see here that while we did have some multiple expansion at the beginning, earnings over the last year or so have really been the driving point, as you see these blue lines here. So stocks are actually, again, no one would argue that they're not overvalued here, but they're actually getting a little cheaper by the nature because earnings are outpacing any sort of multiple expansion, which is really important. Earnings are the lifeblood, and goes back to what Bobby talked about with operating margins. Kind of to sum it up, the last 5 years, the S&P's growth has basically been 1-to-1 with the earnings. If you go back from 1995 to 1999, the S&P total return was 220%, and earnings only grew 67%. So you can see where that bubble really takes place, where the returns were not necessarily justified by earnings.
Excellent explanation. You did great on that. And I thoroughly enjoyed that debate and conversation in our meeting this morning. So folks, you've got the facts. We've given you data. You can see the headlines. but we are wanting to keep you updated and informed. We're doing that in all aspects of our social media: Facebook, Twitter, Instagram, YouTube, podcast, LinkedIn. The list goes on, and especially in this vlog. And I also want to thank you for sharing it with family and friends and colleagues at work. You've opened up doors for us, and we want you to know that when we come to you with information, that we've researched it, we're backing it up with facts, and we're going to continue to keep you updated as we go through this year in regards to these numbers and data and facts. We hope you have a great week. We thank you for watching this vlog, and we look forward to talking to you soon. Thanks.